Over the span of decades, one asset class consistently delivers the highest long-term returns in financial history: equities. But those returns do not exist in a vacuum. They are the mathematical compensation for absorbing the full weight of a corporation's risk. Retail investors often view a share as a three-letter ticker symbol blinking red and green on a screen. In reality, a share is a legally binding contract. It is a precise bundle of economic rights and structural priorities. Today, we are going to map that exact legal architecture from the ground up. We will build what is known as the capital stack, the hierarchy that dictates exactly who gets paid first and who absorbs the losses. Understanding this hidden legal architecture is the foundational prerequisite for calculating true risk and total return in any market. We begin building a company's capital stack at the very bottom. This foundational layer consists of ordinary shares. This represents the ultimate risk capital of the firm. If the business fails and enters liquidation, ordinary shares rank dead last in the priority queue for repayment. The creditors and bondholders are paid first. If they exhaust the remaining assets, the ordinary shareholder is wiped out completely. They get nothing. But the reverse is also true. Once all other obligations are met, the ordinary shareholders own the entirety of the surplus. Because they bear the primary risk, they are granted the mechanism of corporate control: voting rights. They dictate the direction of the company, typically at a ratio of 1 vote per single ordinary share held. The terminology for this layer shifts depending on geography. The UK issues ordinary shares, which often carry a nominal value. The US equivalent is common stock, which typically carries no nominal value, as shown here on this vintage Farmers Cooperative Exchange certificate. The equation at the bottom of the stack is simple. Ordinary shareholders accept structural financial vulnerability in exchange for operational control and unrestricted upside. Directly above the ordinary shares, companies can slot in a distinct layer: preference shares. Preference shares are a hybrid security, blending the legal characteristics of both debt and equity. In a liquidation scenario, they sit structurally higher, ranking ahead of ordinary shares to recover their initial capital up to a strict limit. For a functioning company, their utility is income certainty. Preference shares pay a set, fixed dividend every year. This creates a rigid order of distribution. If a company declares a dividend, the capital flows into the preference layer first. Their fixed quota must be filled completely before a single cent is allowed to reach the ordinary shareholders. This structural priority comes at a cost. Preference shares generally do not carry voting rights. The structure becomes even more rigid if a company misses a payment, provided the shares are designated as cumulative. With cumulative preference shares, any missed dividend rolls over and accumulates as a binding arrears obligation. The company must clear this entire backlog before the ordinary layer can ever be paid. Companies can add further clauses, creating participating shares that capture a slice of excess profits, or convertible shares that can be swapped directly into the ordinary layer. The preference layer exists for investors who trade away corporate control in exchange for structural priority and a reliable income stream. Establishing a position in the capital stack is only the first step. That position must then be legally maintained. The primary threat to an existing shareholder is the company issuing brand new shares to outside parties. Unapproved issuance dilutes the existing investor, shrinking their voting power and their percentage claim on all future dividends. To prevent this, company law mandates a structural safeguard: preemption rights, also known as the right to subscribe. This chart maps a hypothetical scenario for ABC Company. The outer ring represents the total pool of 100,000 shares currently in issue. Investor A holds exactly 20,000 of those shares, granting them a secure 20% slice of the company's total control. Now, ABC Company decides to expand its capital by issuing 50,000 brand new shares. Before a single share can be sold to a third party, preemption rights legally activate. Investor A must be offered the opportunity to buy exactly 20% of those new shares, which equals 10,000 units. If they exercise that right, their total holding increases to 30,000 shares out of a new total of 150,000. Their 20% slice of the company is perfectly maintained. Preemption rights serve as a mathematical necessity, preventing the silent theft of an investor's proportional control. This architecture scales beyond a single domestic market into the global financial system. Buying and holding foreign equity directly involves significant logistical friction, including regulatory hurdles and cross-border tax burdens. The financial industry bypassed this friction by creating depository receipts, such as ADRs in the United States or GDRs in London. The mechanics are precise. A domestic custodian bank holds the actual foreign shares in a vault and then issues tradable instruments that represent that ownership to local investors. Investors can also interact with the capital stack indirectly through derivatives, like warrants. A standard company-issued warrant grants the holder the right to buy ordinary shares at a preset price. If the holder exercises that right, the company is forced to issue brand new shares, expanding the total pool and causing dilution. Contrast this with a covered warrant, which is issued by a third-party bank. Exercising a covered warrant simply transfers existing shares from the bank to the buyer. The total pool remains static, resulting in zero corporate dilution. Whether you are crossing borders or leveraging derivatives, the specific legal structure of the instrument dictates your exposure to underlying corporate dilution. We now have a complete model of the capital stack. We see the preference layer, where investors trade away voting control to secure fixed income and capital priority in liquidation. Beneath it lies the ordinary foundation, holding the primary risk of being wiped out in exchange for unrestricted upside and operational control. Guarding the entire structure is the invisible legal shield of preemption rights, permanently locking these mathematical proportions in place. The equity market operates as a strictly governed legal hierarchy, where risk, reward, and control are permanently and mathematically bound together.